Hello and welcome back to another video. Today we're talking about how much money it takes and how much money you need to build a buy-to-let property portfolio. Now make sure you watch this video all the way through to the very end because I'm giving you 3 ways on how to build a buy-to-let property portfolio, and in each of these 3 ways I'm going to be telling you exactly how much money you need. For those of you that don't know me, my name is Marco. I'm a portfolio landlord, property investor, developer and mentor, and I'm very passionate and I love helping people get into property and invest in property correctly. As some of you already know, and hence the name of this channel, I'm also a private pilot, and I've got some bad news to share with you. Don't worry, it doesn't affect you. Unfortunately, the aircraft needs a new engine. Not only is this going to be offline for about 2 to 3 months whilst the new engine is built and then being fitted, but it's going to cost an awful lot, and the cost is more or less equivalent to 2 more deposits on a buy-to-let property. So maybe you'll be seeing a little bit more of me now that I'm going to have more time in the next 2 and 3 months and won't be flying as much. But if I'm looking outside today, it's overcast, it's rainy and grey, and there's no chance anyone's going to be flying small private planes, certainly in the next week with the forecast. So I'm not missing out on too much at the moment. But let's get back to the main topic of this video, which is how much money do you need to build a buy-to-let property portfolio? Now, first of all, what I'd say here is it depends. Now, it depends on what you class a buy-to-let property portfolio as. Is it 2 properties? Is it 20 properties? What is your goal? How many properties do you want to get to? If that is a goal that you want to put a number to, some people don't. Now, a portfolio landlord, which I am, a portfolio landlord is defined as having 4 or more buy-to-let properties. So you could say, right, I want to be a portfolio landlord, and therefore you need a minimum of 4 buy-to-let properties. So what we're going to do here together for the remaining part of this video is we're going to break down 3 ways on how you can invest in property and how much money you're going to need for each of these 3 different ways. The first is just investing by yourself. You know, maybe you're buying in a personal name or limited company, but either of those ways, it's just you on the books and no one else. So that's number 1. Number 2 is what we're joint venturing with someone else. So we're partnering up with someone else. We're coming together. Maybe we're opening a limited company. Number 3 is where we're borrowing money from someone else to invest. So yes, we're investing just us, but we're borrowing money from someone else and not from a mortgage lender and not from a bank. So it's a third party, maybe an individual or another private company that's lending you money to invest in property. So there are 3 ways. To summarize, we've got just investing with our own capital, our own savings, and we'll talk about this very shortly. Then we've got joint venturing, so actually partnering with someone else. Maybe they're bringing the cash to the table. And the third is where actually we're investing in property. Yes, we're still going about our investment by ourselves, but we're raising the initial source for the deposits and the initial funds from a third party, not from a bank, not from a lender, but maybe from an individual or another private company. So number 1, let's come on to the most common way that people invest in property, and that's by using their own savings. Maybe they've had some inheritance come their way, or actually they've been gifted some money from family. Now, I want to be really clear here. If you're getting money from family to source the purchase of your properties, that's absolutely fine, and lenders and banks are okay with that. But if you're getting money from someone else who's not related to you, they're not happy with this. They will not give you a mortgage if the source of those funds is money coming from someone else that is not family. And that's kind of the third way how we invest in property, and we're raising finance from private investors, which we'll talk about later on in the video. So we've either got savings, we've got inheritance, we've got money from family, and that's how we can use our funds to invest in property. Now, to understand how much money we need when we're undergoing this particular structure, let's go over an example together. So let's say in this scenario, we're not actually buying cash, we're buying with a mortgage. Most buy-to-let property investors will buy with a mortgage. Now, the percentage of the mortgage, the loan to value, which is the amount you're asking for from the lender or from the bank over the value of the property, the amount and that percentage may differ. Maybe we're only looking to finance about 50%. We're only looking to raise a mortgage of around 50% of the price we've agreed to purchase this property for. Or let's go kind of towards the other spectrum. Maybe we're actually looking to borrow a little bit more. Maybe we're looking to borrow about 75%. Or you could be somewhere in the middle. You could look to borrow around 60%. So now we understand how much we're borrowing, and let's just use, for the purpose of this example, we're borrowing 75% of the purchase price. Well, how much do we need for that deposit? Well, it's the opposite. It's the 25%. So we need 25% of the purchase price to contribute for the deposit of the purchase of this property. So now we've got those figures, let's go over a nice, easy, clear example together. So let's say the property we're buying the property for £100,000. So we're getting a mortgage for 75% of this. So our mortgage is £75,000. Our deposit is the remainder, which is £25,000. Nice and easy, right? Well, there are other fees we have to pay to make this deal happen. We've got stamp duty, which at the moment is 3% for investors. We've got our legal fees, which could be somewhere in the region of totaling around £1,500. And we've got our mortgage broker fee, which could be maybe up to £500. So once you add these three other fees together, we're looking at about, roughly speaking, £5,000 in other fees. So we've got our £25,000 deposit plus our £5,000 in other fees. Add that together, that's £30,000. So that's all the cash you need. And don't get me wrong, I'm not factoring in a refurb. I'm assuming we don't need to spend any money on the property. That's all the cash you need to buy this property. So the question then is, well, how much cash do I need to be a portfolio landlord? And as I've already discussed, portfolio landlord is someone that has 4 or more buy-to-let properties. And let's say we want to get to that magic number 4. Well, we've already identified in this scenario where we're buying a property for £100,000 and we're borrowing 75% from a lender, we need £30,000. Well, if we want 4 properties, 4 times £30,000 is £120,000. So in this scenario and in this example, we need £120,000 cash to have 4 properties and therefore be termed a portfolio landlord. However, maybe your goal isn't to get to 4. Maybe you want 2, in which case you need £60,000. Or actually, maybe you want far more than 4. Maybe you want 20, which is £600,000 if I think I've got the maths right off the top of my head. So if you are looking to invest in property, either using your own savings, inheritance, or money from family, this should hopefully answer your question. And if you're still stuck and you're looking for a bit more help, consider bringing on a coach or mentor. Head to my website, ms7.uk, and click on the coaching and mentoring at the top, scroll to the bottom, and please do book a call with me if you're interested. Now, don't fear if you don't have £120,000 cash sat in your bank. Most people do not. And there are 2 other structures and 2 other ways of investing in property using either no cash or very little of our own cash. And the first, which I'll describe to you now, is joint venturing. And this is where, as I've already alluded to earlier on in the video, we come together with someone else, or it could even be 3 individuals. We're coming together, maybe we're forming a limited company, we're all directors. We may have a different shareholding, so the percentage of that company that we own may be slightly different. Again, our voting rights may be slightly different, but in general, we're coming together, we're all adding value in this particular organization. Now, it's really important that you have really clear, defined responsibilities within your joint venture. You know, how is the division of labor split? For example, you could be bringing your expertise and time to the table. The other individual could be bringing the money to the table. So, you know, how are those roles split? What value are you adding to the company? Now, it's really important that you have a good, solid, strong shareholders agreement that you both agree to, and that will keep you on track for the duration of your joint venture. So before we come on to an example here, as I've already alluded to, the percentage of shares that you may own in this joint venture may differ, and there's no right or wrong here. It's whatever you think works well for you and is fair. So for example, let's say you're not putting in money. The other party is putting in 100% of the finance, but what you're doing is you're putting in your time and your expertise. So what you could say is, right, well, I understand I'm not putting any money in, but I'm putting my time in. I'd like 25% of the company. You can have the remaining 75%, but I need you to fund 100%. So obviously you're getting 25% of the profits from the properties that you purchase and maybe rent out, and the investor who's putting in their funds and not actually managing the property or finding or sourcing the properties will receive 75%. So it's whatever you deem fair and right and that works for you. There's no right or wrong here. I've seen people want a higher percentage of the company. I've seen people want a lower percentage of the company. And what you could do here, rather than putting in no money, you could actually be putting in some, okay, maybe it's a small proportion, but some money, again, to increase your shareholding. A really important point to note here is we can still be buying with the mortgages within a joint venture, right? In fact, one reason why 2 people could come together is that one individual is unable to obtain a mortgage by themselves. But actually, by coming together, the other individual, by bringing them to the party, they can obtain the mortgage on your behalf. So actually, you can achieve far more together than you would be able to achieve by yourselves. So when it comes to joint venturing, don't be afraid of mortgages. Don't feel that you need to be buying with cash. You can actually obtain mortgages very easily within a joint venture structure. So let's go over the example that you're putting in no money. Let's just make it nice and easy and simple. And you're taking 25% of the shareholding of that company, whereas the other individual who is putting in 100% of the finance for the property acquisitions is taking 75%. Now, we're not going to talk about voting rights in this particular video, so we're just going to focus on the shareholding. Well, let's say we're buying with a mortgage. Well, we're in the exact same scenario of the previous example. If we're buying property for £100,000, getting a mortgage for 75%, well, the deposit and the other fees needed to purchase a property are the same. It's £30,000 per property. So again, if we use that same logic, you'd need 4 properties, and that corporation, I suppose, will be classified as a portfolio landlord. So that's something to think about there, an option for you to get into property if you don't want to invest your own funds or you don't have that much money to invest in property. Consider joint venturing with someone else who can help you get to where you want to be and build a property portfolio. So that leaves us with the very last and the third option, where we are raising finance from private individuals and we're using this finance to buy property with cash. Now, once we've bought the property and we're on the title deeds and it shows that we own the property or our company owns the property, we can then finance that property and take money out that property to pay back our original investor. So this is the third way of investing in property, and it's great especially if you don't have much money. It's also really good because you fully own the property. You don't have to share this property with someone else. Of course, you've got to pay back the investor, but at the end of the day, it's your property. Now, as I've already mentioned earlier on in the video, if you're borrowing money from a third party, a private individual that's not family, mortgage lenders most mortgage lenders will not allow you to get a mortgage on the property because they don't see those funds as an acceptable source of deposit. So you can't buy that property with a mortgage from the onset. But what you can do is you can buy it with cash and then finance and mortgage that property when you've completed it. And once you've got that money from the mortgage, then you can pay back your investor. And what's important to note here is you can actually put money into the deal. So you don't have to be borrowing 100% of the purchase price from that investor. Maybe you're only borrowing 80% and the remaining 20% you have in your savings and you can contribute yourself. So again, there's a mixture here. You don't have to put no money in. You could put some of your own money in to make this deal work. And actually, if you do put a little bit of your own money in, it really goes a long way for that investor that's lending you money because they know that you've got skin in the game and you've got something to lose if this goes sour. So let's come on to an example now. Now, this one is a little bit more complex. It's not as straightforward as the previous two. Now, there are 2 ways of profiting from this particular structure. The first is by buying below market value. That means you've got lots of equity from day one and you've got lots of margin to pay back your investor. And the second is also by refurbing the property to add value or adding value by other means. And again, this means you've got a buffer to pay back your investor. Now, if you're extremely savvy and it's a very good opportunity, you can buy below market value and add value in the same transaction. So let's go through an example together. And we'll also think about the interest we're paying back to the investor too. So let's say we found a property. Let's say maybe it's worth £120,000, but we've agreed a purchase price of £100,000. So we're borrowing all this money from the investor and maybe we're paying back the investor 8%. So we're borrowing £100,000 and we're giving them 8%, which is £8,000 a year. And let's say this duration is only a 1-year term. So we'll be giving them back £108,000 over here. Let's remember that. Now, we've bought this property. We've already got £20,000 equity because we've bought it below market value. That's great. But let's say we need to do a little small refurb as well. Let's say we need to spend £15,000. Maybe it's a new bathroom, a new kitchen, just a little bit of decorating, just to increase the value. And we can increase the value to £150,000 by doing this work. So we're spending £15,000, but actually we're increasing the value by £30,000, which means, again, the equity on that side of the refurb is a £15,000 equity or profit. Depends how you look at it. So let's fast forward. The property has been refurbed and the valuer has come out to value the property and they're happy at £150,000. So you've applied for a mortgage that's 75% of the £150,000. That means you have £112,500 coming your way. Well, instantly, that's enough to pay off your investor and you've got a little bit of change left over for you. So you've paid off your investor, absolutely great. They're over the moon. They've got their cash back, maybe at 12 months or even before 12 months, which is great. And you've also got maybe about roughly £5,000 left for you. Now, you've already put £15,000 of your money into this deal. So that £5,000, knock it off that, you're about £10,000 into this deal, which is great. You've managed to buy a property below market value, add value to it and exit and pay back your investor, and you only have £10,000 of your own money left in that property. I think that's absolutely amazing. You've borrowed someone else's money to buy a property and you wouldn't have been able to do this yourself because you didn't have those savings in the bank to buy the property. So by borrowing money from individuals, buying in cash and mortgaging at a later date, it's such a great way to invest in property if you don't have that much capital capital yourself to invest. Before we finish the video, I just want to emphasize a really important point in this video, and that's the power of leverage. And what I mean here is the power of buying with a mortgage. Because if you're buying with a mortgage, as I've already alluded to, you can stretch out the money that you have and you can be buying several properties and not just one. But not only that, because you have several properties, what you can be doing is you can be benefiting from several lots of capital growth. You've got maybe 4 properties that are increasing in value maybe over the long run every 10 years. You can benefit from that rather than just having one property go up in value, in the long term because you've bought it in cash. And that's the benefit of buying with a mortgage and with finance. So there we go. I hope you understand how much money you need to build a property portfolio. Now, if you fall into the first category in the first structure where you have savings yourself, maybe you've got some inheritance coming your way, or you can raise money from family and you want some help investing in property, please do head to my website, www.ms7.uk. Click on the coaching and mentoring at the top, just scroll down to the bottom of the page and you can book a call with me at a time to suit. I'm very passionate about helping individuals and people and even companies, family companies, invest in property. Do you have a question? Is there something I've missed? Do you disagree with something? Please do comment below. As you know, I personally respond to all comments that I receive on the videos. I wish you all the very best with your property investing day. Goodbye.